I look at the market and I look at investor sentiment, and there's been a lot of this talk that people are too complacent. Nobody's really looking at the risk out there. What are you seeing?
So I think policy is no longer the day-to-day driver like it was April, May, when we were getting on an absolute basis 4 or 5 percentage point moves in equity markets, just on any kind of headline around, especially tariff policy. So I think we're in a phase much more where the day-to-day is back to being driven by earnings results, back to being driven by the AI theme. But it's really beneath the surface that we do still expect to see the impact of policy changes, including in earnings for certain companies, especially your more retail-oriented, even just more broadly consumer-oriented companies that derive a higher share of revenue, a higher share of suppliers from overseas, and where there's some questions around pricing power.
Do you have any sense of sort of what that impact could be? Because everyone has started to price that in. They price in the worst case scenarios, as you know, and now they price that all out because so far we haven't really seen it materially. That doesn't mean it's not coming. I guess the question is, when it does arrive, is it going to be something these companies can manage, or is it going to be so material that we are going to see a revaluation on some of these stocks?
It's been interesting. And in April, if you take the Mag 7 aside and you just look at 493 earnings expectations, they've been cut in half since April. And I think that was already research analysts overpricing the impacts of tariffs. So far, we've only had 20% of companies report, but they're reporting by a larger than normal share. They're really beating those low expectations. Of course, it's going to be about guidance and what companies say about shifting supply chains and pricing power. So I think that's still to be seen in the second half. It'll especially show up in margins. And I think for the equity market, actually a little bit of CPI inflation is actually necessary as a sign that companies are able to pass, whether it's 50, 60% of those tariff increases onto a final consumer. So we need a little bit of Goldilocks inflation.
That's a good point. I am curious, though, about the potential positive aspects of some of the policies coming. We focus so much on the negative, and there are a lot of negatives. But of course, the president and the White House would point you to the tax and budget bill, and they would say, look, there's effectively stimulus in there. They're not calling it that, but that's effectively what it is. Do you see any potential upside for stocks as a result of some of the provisions in that bill?
So there might be, and I think it's an important offset for the consumer for some of this tariff increase we're seeing and still expect to see, especially in the first half where retroactively households might get a really big tax refund, but it helps offset it. I think it is right not to think about it as stimulus because it's not something to fuel incremental spending. But it is nonetheless something that helps take off a more meaningful slowing of consumer spending off the table. Besides that, for corporations, this idea around immediate expensing, accelerated depreciation, this is something we think companies are going to start announcing a pull forward of CapEx investments, R&D investments as a result of the tax bill. I think elsewhere you can see the impact of policy in things like financials, on deregulation, and also steeper curves because of all this fiscal spending.
We'll talk about the steeper curves. We were talking, my colleagues and I were talking on last week about the latest data on money market instruments and the idea that while they're coming down a little bit, we're still $7 trillion in money market assets. Do you see any sort of meaningful potential for that money to come off the sidelines, if not necessarily out of short-term fixed income and into something riskier like equities? Could it at least maybe go into longer dated fixed income?
And I think we're starting to speak to a lot of investors about that, getting ahead of this resumption of Fed cuts when they do arrive later in the year. We still see a space for about 100 basis point cuts over the next 12 months. That's on the very, very ultra short end. I think what's been interesting is to see a steepening. If you look at the 2s 10s, the 5s 30s, those are much, much steeper than they've been since early 2022. And we think that's the general trend to continue, especially because of all this fiscal issuance that's happening on the long end. Plus just uncertainty about inflation.
But just to be clear, so are you modeling in multiple rate cuts right now by the Fed?
I think we feel more conviction in saying 100 basis points or 4 cuts of 25 over the next 12 months.
Okay.
Previously, we thought we could start over the summer, but I think the feed through to actual tariff revenue and then to actual consumer price inflation is happening more gradually than we expected. Still to be seen over the next few months. And so the Fed would prefer to stay in this wait and see mode. In general, for fixed income, our main conclusions are, look, we're settling in at a range here around elevated rates, very low spreads, and so just focus on the all-in yield. Don't wait to time any kind of improvement in credit spreads or lowering of rates. Just go for the all-in yield, really attractive in things like securitized debt, municipal bonds, high yield, so lots to do already.